Thank you. Good to be here. Big stage for just starting to push. All those people leaving, like this is the most fun talk we're going to do, like all day. They were brainstorming what would be the most exciting thing to talk about, and they said, let's talk about custody, right? Because if you come from traditional finance, you know that custody is the most exciting business. Okay, it's not, I'm done. Crypto's a little different, though. Hopefully we'll make it a little better. My name is Mike Belshe. I am co-founder and CEO of BitGo. Been doing this for about 10 years now. We just had our 10th anniversary at BitGo, based out of Palo Alto, California. I am wearing a suit today. I look like a banker, but actually I'm a technologist, pretty far away from actually anything in the banking space, I think, generally. But I think this is a highly technical space that needs actually technologists. So I hope a lot of you guys are on the technology side. We are making some changes here. All right, I got a slide deck. Software ate the world. Who said software is going to eat the world? Mark Andreessen? Yeah. Look, software has been doing this, right? Supply chains, information systems, pretty much every industry we have has changed except for one, which is the financial system. The financial system is kind of the last bastion of unimproved services by way of technology. They thought spreadsheets were pretty exciting. Look, crypto is going to eat the world. Finally, we have software which is starting to permeate the moats of traditional finance, in particular because of regulatory reasons. It's money. It actually should be, in a lot of ways, protected by way of a whole bunch of moats that prevent software from coming in irresponsible ways. But it's a big deal. And this is what BitGo's been working on for 10 years. I'm going to go into a little bit for it. We have at BitGo kind of two sides of what we do. One is wallets, which is all non-custodial. We pioneered multi-sig wallets back in 2013. Today we do multi-sig, we do MPC, but everything we do starts with a core of multiple keys. So we use this 2 out of 3 system predominantly, and our clients like it quite a lot. A little bit about BitGo. If you haven't heard of us, we're kind of the brand behind the brands in a lot of cases. We've got hundreds of exchanges that use BitGo services, but it's not just exchanges, it's broker-dealers, it's payment providers, it's hedge funds, even some endowment funds, which I find exciting because endowment funds typically are about preserving wealth. And when you think of preserving wealth, you don't necessarily think of your high-risk assets. But we do have some of those, and it started in just the last couple of years as these markets are getting stronger. We grew really fast. I think we're maybe one of the fastest, if not the fastest growing custodian. We went from 0 to $68 billion in assets under custody in just a couple of years. We do about 20% of all Bitcoin transactions by volume. This might be surprising because a lot of times people think of us as a custodian, but actually remember we have both sides. We have real-time wallets. A lot of times those are run in a non-custodial self-custody manner. A lot of exchanges are using that. We also have custody for the deep cold storage. Let's see a few other stats. Insurance policy. Look, we pioneered insurance a long time ago. If you look at the fiat system and the traditional finance, insurance is less important. The government can bail out and does bail out banks almost on a regular basis. But in the crypto space, this asset, if it's gone, it's gone. So pioneering insurance, we started it, I think, all the way back to 2016 with a small little $10 million policy then. Today we have $250 million of base coverage. Our clients buy, I think, what is the largest policies total in combination. It's about $700 million in total cover at BitGo. And actually, that's growing above the $1 billion mark within the next couple of months here. All right. So let's talk about custody, kind of where custody is. I want to talk about where things are going. I think it's exciting because we are actually unlocking a true global financial system. At the base of what we do is still security. And when you think about custodians and who should be a custodian, it's really important for digital assets, I think you probably know this, to have a company that is based in technology. At the core of what we do is this non-custodial wallet. Then we take that and we run it in another fashion for custody. But the blockchains are changing constantly. The technology is changing constantly. Like I said, we started with multi-sig, and on the Bitcoin network, I would still argue that is absolutely the best way to secure your digital assets. But on some of the newer chains, actually, you can do better with some MPC and threshold signatures. So you need somebody that's doing it right here. We have had failures in the just last couple of months in the industry, where some companies that buy wallets from other parties don't necessarily have a really strong platform. I'm talking about Prime Trust here. They had a failure. They're a Nevada-based trust company. They were using other people's technology for the wallets. That part was okay, but actually their own technology above that was not as secure. So above the foundation and security is regulatory, and pretty much all of our clients are looking for what we call qualified custody. It's a little bit of a mysterious definition to some, but it's actually pretty simple. It's about A, making sure that the custodian's asset or the financial institution's assets are never commingled with clients, and B, that even if the financial institution should go bankrupt, that your assets are your assets, so you keep your ownership all the time. So that's what qualified custody is. And the exchanges in our space that grew up and helped build this industry, a lot of them don't operate as qualified custodians, which means that if they run into trouble, like FTX, your assets that were at that exchange, you now become a creditor to the exchange. Of course, we learned this all the way back to 2014 and earlier when there were failures in the early industry. All right, above that, there's been a lot of work on settlement and liquidity. So I'll get into market structure in a moment, but if we were any other asset class, there's a whole bunch of participants that help make it so that even if you have your assets in deep cold storage, that you can still connect and have access to exchanges for liquidity and all of your needs. We have to build that. So custodians have more or less built this. BitGo has put this together at this point. It's kind of the basic offering, and then of course this enables building a prime brokerage and apps. I don't think this stack is done. So you hear about prime brokerage in our space quite a lot. The 2022 failures that we had, whether you want to talk about Celsius or BlockFi or whatever, we had rampant lending with irresponsible taking of risks, people not fully understanding how these assets, how lending should be collateralized and whatnot, and not having the risk mitigation systems and liquidation systems in place to cover it. Custody is a key role here, and it still needs to be built further. Anybody that's pre-funding exchanges where the exchange does not have access to something that's qualified custody, if that exchange should fail, you're going to fail along with it. So we're still building there. I think a lot of people here in this room are probably building at that level. All right, so what does market structure look like today? Look, I'm an engineer, so I guess we'll put up a complicated slide, which is like roughly what the market structure in the equities markets looks like today. So that is, anything regulated under the SEC and FINRA in the United States looks about like this. But frankly, if you look at other markets around the globe, they don't look that different. Usually the names are kind of different. On the left side here, you can see kind of the buyer's financial institutions. He's got a broker, he's got a bank or custodian. On the right side, you've got the seller's side. And then in the middle, there's a bunch of parties from the exchange, the clearinghouse, and ultimately to transfer agents and custodians that are supposed to be the risk mitigated components that help you with stable trading in markets. The crypto industry looks instead about like that. And that, of course, is the problem. And this is, I think, right now, still the single most important problem for us to solve in order to bring institutions, traditional finance, into crypto. Now, you might say, why do we want to do that? Which is actually a fair question. But at BitGo, our belief is we want everybody to be able to participate in digital assets. So, of course, we've had self-custody. Retail has been able to get into this space as part of why all of us are here. It's so exciting. Retail and individuals are on the same level playing field with exchanges and institutions that previously had a lock on the most important parts of the financial system. But we want everybody to be able to participate. We want businesses, we want financial institutions. When we get true ubiquity, then actually we get to start making the biggest changes in crypto. But the market structure like this has inherent risks to it, which frankly blocks out a whole bunch of people from participating. If you are a pension fund, you have multiple investment committees that look at where your risks are, who your counterparties are, with deep diligence and evaluation. And making a $100 million deposit onto Coinbase does not fit your risk profile. So it's absolutely key that we start to change this. And what's missing is, frankly, checks and balances. Look, Mt. Gox on the old. I intentionally picked 2014 hack of Mt. Gox, and then on the right side there we have FTX, which is just just under a year old from happening. But in all of these cases, if we had separated trade and custody, it would have either been significantly mitigated or prevented altogether. Let's go through it. So Mt. Gox, I don't know how many, raise your hand if you were in the industry in 2014. Okay, we got a couple. All right, great. But most people weren't. So I don't know if you know what happened with Mt. Gox, but Mt. Gox was, of course, the largest exchange for trading Bitcoin at the time. and they started to lose money, and it dribbled out. We only learned about this after the fact. They were losing by way of hacking and people taking advantage of various things. And the owners realized that they didn't have all the Bitcoin that they were supposed to have for the depositors. So they started trying to trade and trying to earn it back through various schemes. Of course, all of those failed, and by the time everyone eventually realized there were 600,000 coins missing, it was too late. Look, if they had been forced to have a separate custodian away from the exchange, they would have had a balance that they said that they claimed to have on behalf of their clients. There would have been somebody to be a check and a balance for that. CoinCheck, separate example. Anybody heard of CoinCheck? They got renamed. All right, we got the same guys here. All right, those that have been historically in the space. CoinCheck, I think it was around 2018 that they had a failure. They lost about $600 million worth of NEM coins. CoinCheck did phenomenally well, based out of Japan. If you had gone to Tokyo around that time, you would have seen CoinCheck plastered all around Tokyo. And when they started offering trading of the NEM coin, they put together a single signature hot wallet which held the NEM coins. And of course, all of you in this room probably know enough about technology to know that that's probably not a good idea, but I would argue it was actually pretty safe because they had 0 NEM coins in it, and that's perfectly fine. They could probably tolerate a loss of 0. But those plastered billboards that said CoinCheck all over town helped them grow their business. And their real job was signing up 100,000 new users a day. And as they did that successfully, the volume of NEM coins on their exchange went from 0 to 5 million to 10 million, still in the single sig hot wallet, to 50 million, 100 million. All along this way, I guarantee you, there was staff inside of CoinCheck saying, I wish we had a better way to secure this stuff. Maybe we should do something. And yet, the business side was growing so much, they just had to focus on that until it was too late. They lost $600 million. One of the, still, I think, I don't know, top 3 or 4 sized failures kind of ever. So the point is that, like, look, exchanges, all the guys at the app side, the prime brokers, et cetera, you know, they need a really solid foundation, back to the triangle that I drew at the beginning. And they need, and that there's specialization with that security that goes on, which frankly, most applications don't have the time nor the expertise to build. All right, CoinCheck, on the good news side, they made so much money on their exchange trading, they were able to pay back all their clients. So, look, that's phenomenal, but it won't always be true. The reality is we need to separate these things. Finally, FTX. FTX, you know, most familiar in everybody's minds. I bet if I asked for everybody to raise your hand, everybody's going to say they heard of FTX. Look, it's a different game with FTX. Obviously, Sam Bankman-Fried, a massive fraud. He was the same as Bernie Madoff. Since we're in Korea, does everybody know who Bernie Madoff is? All right, I'll tell you anyway. Bernie Madoff was a hedge fund manager. I believe he was like chairman of the New York Stock Exchange, if I got it right. And he built the largest Ponzi scheme in the history of the United States. He ultimately was exposed as part of the 2008 financial crisis when he no longer had the assets to keep up with the withdrawals that were coming for his Ponzi scheme. He has said if his clients had required him to use a third-party custodian, he could not have perpetrated the crime. And the same thing is true for Sam Bankman-Fried. Look, that guy claimed to have all these assets, and all it would have taken is a modicum of inspection. And that absolutely could have been figured out. And even if you don't believe that statement is true or you think it's too bold, there's no doubt in my mind that if he had had just a few other checks and balances verifying that what he had, it wouldn't have happened. So look, the industry can't grow up to institutional levels until we solve this problem. And we will continue to have another FTX in the future if we do not. All right. So let's talk about what BitGo is doing about it real quick. I guess it looks like an advertisement for BitGo to some degree, but I think this is important stuff. There's a few different companies that are trying to work on similar types of things, and I think it's important. One of the things I forgot to mention at the beginning of the talk, I'm a technologist by background. I am the lead author of the HTTP 2.0 protocol. So if you use your browser today, you might have used some of my work from my Google Chrome days. And what the HTTP protocol is about interop for how clients and servers on the web protocol talk to each other. And there's a body of of folks, it's a standard organization called IETF, Internet Engineering Task Force. It's been around since like the 1970s. It helps standardize those protocols. BitGo is building a Go network, which is the ability for us to instantly settle funds. And currently, we do it inside of BitGo. What's coming next is how do we do that not just inside of BitGo, But how do we do that across custodians? Why is it that a buyer and a seller both need to be aggregated at a single financial institution? Look, it takes time to evolve these things, and that's what's coming. In the meantime, the settlement network that we've built, what it is first thing, in the wake of Silvergate Exchange Network, raise your hand if you heard of Silvergate Exchange Network. SEN, Silvergate, Bank, San Diego. All right. Up until about February of this year, Silvergate was the dominant flow of US dollars between various market participants in crypto. It was a small San Diego bank, state chartered in California, and 95% of its revenue came from crypto companies. They died spectacularly in February of this year because all of us in this room decided that we were afraid that they were going to be insolvent, and we all withdrew our money. Their profits went to zero. They had to shut down. Good news, nobody lost money. So they're a well-run bank. It just happens that we had single-party concentration risk. All right, in the wake of that, we finally get to build settlement actually the way we want to. BitGo Go Network does this. Silvergate was born because about 2015, there were all these settlement flows that were happening. They were happening between Cumberland and Jump and Coinbase and Kraken and everybody. And the crypto markets run 24/7. But the traditional markets run Monday through Friday, 9 to 5, US hours. So it didn't work that well in terms of mitigating risk for all those dollar flows. Silvergate steps in. They create a mechanism where you can do account-to-account transfers inside of Silvergate, 24 hours a day, 7 days a week, instantly. Over the next 6 years, basically every crypto participant, from SoFi to Square and all the guys I mentioned before, everybody had Silvergate accounts, and that was the dominant way that the fiat side was being settled. With Go Network, we can finally deliver what's called DVP. From those of you that might be from the traditional finance world, DVP, delivery versus payment, is a fancy way of saying atomic swaps. It's the ability for me to send $5 million of ETH and $5 million of Bitcoin to you, and for you to send me $10 million of cash, and either those two things settle together or they don't settle. So it's the fundamentals of clearing and settlement. We could do that today inside of BitGo. That's the Go Network. The second thing which the Go Network does, key part of custodianship, is starting to get the assets off of the exchanges. So BitGo spends a lot of time on cold storage. How many here use cold storage? All right, good. Some of the newer people are also using cold storage already, which is good. Look, for smaller amounts of money, I think we've got pretty good security in place for non-custodial wallets. It doesn't always have to be cold. But if you're securing billions of dollars, your main job, your one job is do not lose the money. And that's what we do. We spend a lot of time, a lot of money on it. We eliminate single points of failure, which means there's no single machine that has access, no single person that has access, no single place that has access to the key material, all of these things. But after we've done all that work, then you want to get out of a position in Bitcoin or Ethereum or whatever it may be, and you take the assets out of that safe, secure, cold storage, and you drop it onto an exchange like FTX, and then they die, and you lose all of your money. So there's a huge problem there on risk. And then the second thing is it's also terribly capital inefficient. So a number of people got burned. Pretty much all of the market makers, all of the prime brokers in crypto got burned by FTX. Galaxy publicly stated they lost 70 or 75 million. Why did they have 70 or 75 million on FTX? Well, the really more important question is, in addition to having 70 or 75 million on FTX, they also had the same amount on about 5 other exchanges, somewhere in the neighborhood of $200, $300 million, just by math, exposed on various exchanges. This is incredibly capital efficient. You don't see this in any other market structure. And frankly, this inhibits the digital asset, the crypto space, from growing. So with something like the Go Network, we do this today. We're integrated with Bitstamp. We've got Gate.io, INX coming soon, a handful of others coming after that. Now all of a sudden you can keep your assets in cold storage. You can see it on the exchange. You can trade it, settle it. The only exposure you have is the settlement component, which is so much smaller than having the principal at risk all the time. But maybe the most interesting thing, especially for this talk here, because we are in Korea, is now we can start to see a path for how do we get interop between custodians and how do we start to make it an international global financial system. So connecting global markets. This is BitGo's offices and custodians today. It's a changing regulatory landscape, as all of you guys are aware. Every single jurisdiction, every regulator, every legislator is thinking about how are they going to regulate, how are they going to monitor the activities of digital asset trading and markets. And They are mostly coming up with similar answers, but they're also coming up with some different answers. All right, so BitGo has 2 qualified custodians here in the United States. That's in South Dakota and New York. We have 2 in Europe, in Switzerland and Germany. We have 1 coming in Dubai, hopefully by the end of this year, Singapore by the end of this year, working on a couple of others as well. The point of this is that we're going to have qualified custody in multiple regions. Now, it might sound like, oh, it's just all BitGo, but when it comes to regulated qualified custody, even though it is affiliated companies inside of BitGo, each one of those has separate management teams, each one of those has separate controls, and every single one of those regulators wants to make sure that their regulated entity is not just under the thumb of some US company that's holding all the keys. So it really is separate. An account at BitGo New York Trust Company is different than an account at BitGo Deutschland Trust Company. And that's a really important step. So now we can start to build protocols where you can start to now swap at the custodial layer. But there's another important thing here. In the US, regulations have become so nasty, it's almost the third world of crypto regulation. Non-US companies do not want to come to the United States. Why would you take crypto assets that are safe in Europe or in Asia and take them to the US unless you absolutely needed to? So what we're seeing is that companies want to onboard to qualified custodians in their region, in their locale, instead of at some faraway land. So what we can do is we can now onboard, I'll say Deribit, not to say we're doing anything with them, but we could onboard Deribit into Germany, which they would feel very comfortable. A US client who may have a difficult time onboarding to Deribit can onboard through BitGo New York, and then we can connect the settlement behind the scenes, which is what we're building next. All right. So let's talk about South Korea for just a minute, because we are here. What I have been seeing, and I've spoken to regulators across the globe about digital asset custody and how it fits. The good news, I mean, regulators understand the need of custody. It's actually one of the simpler things to regulate by itself. The trading is perhaps harder. What's a security, what's not a security, and those types of things. But look, South Korea is standing in a very good position. South Korea is already, by volume in terms of fiat currency trade against Bitcoin, is already number 3. It has a deep history with crypto. Regulations dating back to 2017, 2018. Has some battle scars from some things here in the country that haven't worked out quite as well. But those lead to having regulators that are interested and want to solve the problems. There's currently about 7 bills here that are pending to start to bring clarity. And when you talk with the regulators here, you'll hear a different story about wanting to make the industry work, as opposed to trying to perpetuate maybe a legacy regulatory system that might not be the exact fit for crypto. So I think absolutely that South Korea could be like a hub in Asia for crypto if a few things fall into place. So everybody here that's from South Korea, you know, kudos to you. Kudos to you, especially if you've got sway with regulators and help make this start to happen. But that leads me to, I guess I got one more thing, Steve Jobs style, and we do have an announcement. So we're excited to announce that BitGo and Hana Bank have entered into an agreement to try to offer custody here in South Korea. It will be the most compliant and safe way to store digital assets here in Korea. I hope it'll be a really great thing for not just South Korea, but actually potentially all of Asia. Hana Bank, we are proud and humbled, frankly, that they have chosen us to help them with this effort. They are serious about it. It's not going to be an overnight thing. It's not going to show up tomorrow and suddenly open for everybody. This is a thing that we have to build together. But this starts to bring the traditional financial system into the crypto world. And by doing that, that's going to make digital assets ubiquitous. And we think that that's a future custody so that we can get going with actually building the better financial system that we're all looking for. All right. That's all I've got. Thank you, Al.